What's up, guys? Welcome to the final economic update of the year. And what a year it has been as we come to the end of 2021. My gosh, we have seen ups and downs in this economy.
It's above me now.
Largely due to the C word, the vid. And now as we close out, let's have a look at what's happened over the course of this year and where we expect to go next year. By the way, guys, subscribe and follow me on Instagram. I'm at Warren Gosling. I love interacting with you guys on there. Give me a cheeky follow. So let's start with GDP growth rate. So quarterly GDP growth rate, this bar right here is the third quarter of this year to September 2021. Compared to last quarter, 5.5%, there is a dip, but it's still positive, guys. It's still blue, thank the Lord. The economy is still growing. Now, the 5.5% growth in the last quarter was mainly due to further easing of restrictions in the economy. So we're talking about stuff like hospitality and leisure. The industry was further reopening. The arts was a big contributor to this as well. Theatres reopening and so on and so forth. So a healthy jump there. And the last real big jump was in the third quarter of 2020, so a year ago. And again, we had just come out of the back of the extended lockdown for the first half of the year, and stuff was beginning to reopen again. So we saw that big boost here. So now, as we come towards the third quarter of this year, we're seeing still growing. The economy is still growing. Don't forget that, guys. However, as you might have observed over the last few months, there has been supply side shortages throughout the economy. Primary example being the fuel shortage in the UK. Now, that wasn't necessarily because there was a shortage of fuel itself, more so a shortage of drivers. So it was more of a labour supply shortage. And the knock-on effect of that being that if there's not enough drivers to bring the goods that we need from Europe and other parts of the world into the country, the economy is going to suffer because people aren't getting what they need. So overall, positive, 2 quarters of positive growth, but a decrease in the rate of growth. Now, if we look at GDP, same exact metric, but from an annual perspective, we can see that right now we are 6.6% up on last year. Why is that? Really simple, guys, because this time last year, so we're talking about December 2020, the bulk of 2020 was lockdown territory. People were indoors, guys. Businesses were closed, people were on furlough, no trips to bars, no trips to cinema. It was Netflix and chilling. And even the chilling part, guys, was a bit peak because we weren't allowed to mix. So it was just Netflix. Whereas this year, for the majority of this year, not all of it, but the majority of it, businesses have been open, allowed to trade. And so overall, we're up on last year. And what I want to look at next, guys, is the money supply. Now, I haven't looked at the money supply for a few months. And when we talk about money supply, guys, we're talking about quantitative easing. Now, quantitative easing is what the government does. They print money and they primarily buy bonds from large institutions like pension funds, insurance funds, and banks. The idea is that by buying back their own bonds, that money that the institutions get in exchange should then seep into the economy. So we're talking about things like higher wages, opening new divisions, opening new offices around the country, around the world, higher bonuses, all of that in the hope that the economy will be stimulated through this mechanism. Now, there are lots of opinions and views and papers and pieces on whether this works in practice. And the ones that I've read and pay attention to seem to suggest that all of this money, these billions that the government, hundreds of billions that the government pumps into the economy, doesn't necessarily seep down to you and me. I don't know about you, but I have not gotten a pay increase in the last 18 months since we've seen this hike here in the printing of money and dissemination into the economy. I don't know about you guys. Let me know in the comment section below if you have. Interestingly though, guys, what these thought pieces do seem to suggest is that the bigger effect of this printing of money and dissemination to the economy is asset price inflation. When we're talking about asset price inflation, we're talking about things like Bitcoin, houses, the FTSE 100, or global stock markets going up in price, because essentially in really high level terms, what they say is that these businesses who are receiving these billions of pounds from the government in return for selling these government bonds, they essentially keep the money on their balance sheet. They don't transfer that wealth, that income to the likes of you and me, their workers. What they do is that they buy back their own shares, they invest in assets like property, and that drives up the price. Now, is that true in practice? Well, let's take a look. If we start with the property market here, in fact, let's go back. So what we see is a big hike in the printing of money from, let's call this basically February 2020 onwards. So the beginning, let's call it Q1 of 2020, huge increase in the amount of money. You're going from around about 2.9 trillion to 3.5 trillion. So a huge influx of money into the economy. So if we look at Q1 2020, what's happened to property prices? So Q1 2020, let's say March 2020, the average price of a property in the UK is £232,000. We're now at £270,000. 16% increase in a year and a half. Just to put that into context, the average growth of the UK property market over the last 20 years has been 5.6%. So we've gotten round about 3 years worth of growth in a year and a half.
Jesus Christ.
Back to this, it looks like this influx of money into the economy is having an effect on assets. Let's look at what's happened to the FTSE 100. Let's go to March Q1 2020, 5190. Fast forward to now, we're at 7160. 38% increase in the average price of a stock on the UK FTSE 100. Looks like this increase in money printing is having an effect on assets, guys. So money supply has an effect on asset prices, it would seem. And then, guys, moving on to interest rates. So I thought, if you watched last month's video, I was convinced that the government was going to raise the interest rate because we can't stay at 0.1% forever. Inflation is high. Let's take a look at inflation here, 4.2%. If we look over a longer term period, wow, it hasn't been this high. Let's go even longer. Hasn't been this high for almost 10 years, guys, 10 years. And we know that the Bank of England target inflation rate is 2%. So we're more than double the Bank of England target inflation rate. What does the Bank of England normally do? What does a monetary policy committee normally do when inflation is going out of control? They raise interest rates. Why? Because it makes borrowing more expensive. People have less money in their pockets at the end of the month, end of the year. And the theory is that it slows down spending and prices cool down and inflation comes down. So we've got this 0.1 interest rate, which is basically encouraging spending, encouraging stimulation of the economy. And if we go out over the maximum horizon, interest rate has never been this low in the history of the UK economy, right? And it's been at under 0.25% for over 10 years. Wow. So anyway, I'm saying all this to say that I believe that the interest rate is going to be increased soon. It has to be. Otherwise, inflation is going to run out of control and the government doesn't want that. So let's watch this space, guys. So lastly, guys, what's going to happen next year? What does the Bank of England think is going to happen? This is their monetary policy report for November last month. Let's skip on down to the summary. So they're talking about the 2% inflation target that we mentioned earlier on. And this is the interesting part, the economic outlook. So what are they saying here? They're saying that growth is somewhat disrupted by disruption to supply chains, which we talked about earlier on also. And they're talking about inflation. And they're saying that it's been driven by or boosted by higher energy prices. I know that materials are costing a lot. We're actually getting some work done in our house if you're interested. And one of the things that the tradesman said is that the price of materials is through the roof right now. I think that's due to supply issues as well. And the Bank of England think that inflation is going to continue to rise and peak at 5% in April 2020. Well, they better increase the base rate interest rate then if they don't want that to happen. So what are they saying about 2022 and beyond? If we scroll down, we can see a handy table here. So they're saying that GDP is going to end the year at 6.7%. Currently for the third quarter of this year, so this is Q3, 6.6. So they're saying for Q4 it's going to be 6.7. Can't see any reason to disagree with that. But interestingly, they're saying over the next 3 years, GDP is going to decrease to 2.9% for the year ending 2022, 1.1% for 2023, and 0.9% for 2024. Wow. Now, it'll be interesting to see what they say is driving that. For the purposes of this video, to keep it concise, I'm going to end it. Thank you for watching to the end. Guys, I've put together a property dashboard tool. If you're looking to buy a property in a short or medium term, this dashboard is going to calculate all of the key metrics and figures that you need to know when you're buying a property. It's going to automatically calculate things like your stamp duty costs, your returns, your profits, the future rise in value of your house, and if you're overpaying for that property relative to the UK average, as well as many other useful metrics and figures. The link is in the description below. And now back to the video. And we'll look into the drivers of that in the January update, but let me know your thoughts. Wow, this is a pretty pessimistic, guys, but let me know what you think. Have a good Christmas and I'll see you guys next year.